And welcome back. Average 30-year fixed rate mortgage rates just increased to a 8-month high to 7.22% on Thursday. For someone looking to buy an average price home today compared to 12 months ago, it's going to cost them hundreds more per month in their average monthly housing payment due to this giant increase in rates. Meanwhile, housing affordability is now the worst on record because home prices, surprisingly, are still on the rise this year despite these high rates. So in today's video, I'm going to share all the details with you guys. So hope you guys get a lot of value out of today's video. And of course, please hit the like button if you haven't done so already. And of course, also consider subscribing as well because I post frequent housing market updates so you guys can make a more informed decision about whether to buy or sell a house right now. Okay, with that said, I have a lot to share in today's video. Thank you so much for joining me in today's video here. And again, here's the headline right here. Average rates for people with great credit, by the way, according to the Mortgage News Daily, is at 7.22%, a giant increase of 14 basis points compared to Wednesday. Also, 7.22% is not too much far off a 12-month high. The 12-month high was at 7.37%. Also for a jumbo loan is just under 7%. And also for FHA and a 30-year fixed VA loan is also around 7% as well. So one question, of course, is why did rates increase by 14 basis points on Thursday? And the reason for this, very briefly here, is this right here. Of course, as you guys all know, average rates for mortgages is loosely tied to the yield on the 10-year U.S. Treasury note. And that actually increased to over 4% on Thursday due to a stronger than expected employment report that was released here by the ADP. Rates have already begun rising last week, following signals that the Fed is going to start increasing rates once again after a pause in June. Also, in remarks to Congress after its June Fed meeting, Fed Chair Jerome Powell said the central bank has a long way to go to bring inflation back to the 2% goal. The next interest rate decision is on July 26 here. In regards to this stronger than expected employment report, I mean, this is really a blowout report here because according to the ADP, the report here showed that in the private sector, jobs jumped by 497,000 for the month of June. This beat expectations by a long shot because the expectation was for 220,000 and it came at 497,000, which is also much greater than May's gains of 267,000. So because of this much stronger report here regarding the jobs market, this is why the 10-year U.S. Treasury note surged by nearly 8 basis or just over 8 basis points to over 4% right now. By the way, the last time that the 10-year was at 4% or higher was way back on March 1st this year. So because the yield on that increased greatly, that's why we had a giant surge in rates today, which again is July 6th on Thursday. Average rates at 7.22%. 1 year ago, it was at 5.65%. That's an increase of over 1.5 percentage points over the past 12 months. So here's the true impacts regarding these rising rates for home buyers right now. This is a common example that I share on the channel pretty frequently here. So because rates went from 5.65% for someone looking to buy a average price home today, which the median sold price nationwide is around $400,000 at the time of filming this video. Putting 5% down, your housing payment 1 year ago, based on rates 1 year ago, was just under $2,200 per month. Now fast forward to today, average rates at 7.22%. Your new housing payment is actually just under $2,600 per month. That's an increase of $400 more per month to buy an average price home today compared to 12 months ago. That's number one. Number two is that because rates have increased by about 1.5 percentage points over the last 12 months, you're going to pay a lot more in interest owed or interest paid over the life of that loan. So over a 30-year loan here, you're going to pay approximately $140,000 more in interest paid over the life of the loan. Because going back 12 months ago, again, for buying a $400,000 house, your interest paid through July 2053, a 30-year loan, is just under $410,000. Now, because rates have increased to 7.22%, your interest paid over the life of that loan is now $550,435, an increase of around $140,000 more in interest paid. On top of that, because rates have increased to 7.22%, this is an 8-month high, because the last time rates were this high was way back on November 9th last year, when rates were also at 7.22%. Now, here's something very important to know as well, because average monthly housing payments, according to the MBA, just reached an all-time record high. In other words, housing affordability is the worst on record, according to data from the MBA here. It says here that application payments, or mortgage application payments, these are housing payments based on applications for home loans. People submitting applications for home loans, looking at those payments. That increased by 2.5% in May. The average monthly housing payment based on those payments, or those applications, was $2,165. And according to the MBA, homebuyer affordability eroded further in May as prospective buyers continue to grapple with high interest rates and, of course, low housing affordability for existing houses. While supply remains low, we do expect that inventory will pick up in the near term, which will provide more opportunities for borrowers to buy a house. I would say that's really due to two main reasons, and that's seasonality, because housing inventory tends to peak in the summer months each and every year during a normal housing market. That's number one. Also, number two is decreasing demand for home buyers as well. Because when we have a decrease in home buying demand, it takes longer for houses to sell, and that theoretically increases the number of houses for sale, or increases housing inventory because there's less contracts being signed between buyers and sellers. But going back to housing affordability, their Purchase Applications Payment Index, or their PAPI, P-A-P-I, again, that decreased or actually increased by 2.5%. An increase in this index means that housing affordability is actually getting worse here. And it says here, right here, this increase is indicative of declining borrower affordability conditions, which of course means that your mortgage payment to income ratio is higher due to increasing application loan amounts, rising mortgage rates, or a decrease of earnings. And as you can see by this chart right here, which goes back to July of 2009, their index, which of course is a measure of housing affordability. Again, when an increase in their index means that housing affordability is actually getting worse. As you can see here, for the month of May, it reached an all-time record high, well above pre-pandemic levels, when their index was actually much less than it is today. Now, here's something we also know as well. This was reported on Wednesday, according to the MBA here. They reported that applications for home loans actually decreased by 4.4% compared to the previous week. However, what I'm more focused on is this right here. The seasonally adjusted purchase index, which is a measure of the amount of home loans to buy houses, that decreased by 5% compared to the previous week. It was also down by 22% from 1 year ago. According to Joe Kahn, who's the MBA's vice president and deputy chief economist, he stated the following: applications fell to the lowest level in a month last week as rates for most loan types increase. Which makes sense, right? Applications decrease when rates increase. Purchase applications decrease for the first time in a month as home buyers remain sensitive to rate changes. Rates are still over a percentage point higher compared to 1 year ago, and housing affordability is still a challenge in many parts of the country. Here's another trend we're seeing right now as well. Here is the National Association of Realtors Central Lock Home Showings Report. This is a measure of real estate showings across the United States here. So on a national level, home showings were down 3% compared to May of 2022, 1 year ago. Home showings decreased in each of the 4 major regions except for one of them. So for example, home showings this May compared to last May in the Northeast fell a whopping 15%. The Midwest fell by 10%. The West decreased by 4%. In contrast, though, in the South, home showings increased by 2%. Before we look at more recent trends regarding home showings across North America, here is showingtime.com. So for the week ended July 4th, home showings this year decreased by 5.6%, whereas last year at this time, it decreased by 21%. Compare that to 2021, home showings actually increased by 2.5%. One thing you guys should be aware of, though, if you guys haven't followed the channel yet, and this is your first video, for example, this report right here covers home showings compared to the first week each year. So for this year, home showings are down by 5.6% compared to the first week this year. And also compared to last year, they're down by 21% compared to the first week of 2022. And this, by the way, has been a common pattern we've been seeing here because home showings in 2021 were much higher compared to 2022 as well as 2023. Let me just exclude 2021. Also, home showings compared to last year were actually better than last year ever since the middle of April this year. So I'd love to hear from you guys. What do you guys think about rates increasing to 7.22%, the highest rates since early November last year? In my personal opinion, this is a bad timing, I would say, because during this time of year, we tend to see a decrease in home buying activity. We tend to see fewer houses being listed for sale. But in the second half this year, or the second half each and every year, I should say, we tend to see a decrease in our housing market in general, a decrease of activity. So this is going to be very, very interesting if rates stay at these very high levels, historically speaking, over the past several years here, because if we have a decrease in home buying demand due to seasonality, you couple that with rates that haven't been this high in about 8 months, that's a recipe for a housing market to decrease further than it would have during this time of year. But what do you guys think? Please leave a comment below. Thank you so much for watching today's video. I appreciate you. Hope you guys have an awesome day and look forward to seeing you in the next video.